November 5th, 2024. Trump's back in office. Market-beating returns are going to be served on a silver platter. How you can position yourself to potentially secure life-changing gains when this bull run takes off. Historical patterns show the bull run signal. Institutional investors are making big moves into the market. The next steps you take could make all the difference. You've seen the proof, and now I'm about to show you how to take full advantage of it before any of the masses catch on. Let's dive into an investment strategy that no guru will ever tell you about. They'll just tell you to buy Bitcoin. But us, we're becoming our own bank to tap into returns beyond Bitcoin. Segment number 3, 3 steps to position yourself for this bull run. Now, let me break down a simple 3-step strategy to help you ride this bull run with maximum efficiency. Step number 1, when you're building a strong investment foundation, stability is key. Just like setting a solid base when constructing a house. In DeFi, these anchor assets are stablecoins, such as USDT or Tether or DAI. Stablecoins hold a 1-to-1 value with the US dollar, which means their price stays relatively stable, unlike the fluctuations you see in Bitcoin or Ethereum. Now, you might wonder, how can stablecoins generate returns? If stablecoins are pegged to the dollar, you might ask, where do the profits come from if they don't go up in value? Well, this is where the power of liquidity providing comes into play. When you provide liquidity in DeFi, you're not just holding onto an asset, you're actually putting your money to work by allowing others to use it for transactions. When you provide liquidity, you're essentially filling the role of a bank. You become your own bank. Imagine you're providing the funds needed for transactions. This process enables other users to trade or swap their crypto assets without relying on a centralized bank. In return for making these trades possible, you earn a cut of the fees that each trader pays. Providing liquidity is similar to owning a toll booth. Every time someone uses that section of the road, they pay a small toll. In DeFi, each transaction generates a small transaction fee. The more transactions that occur, the more fees you collect, creating a reliable source of passive income without the price risk associated with most crypto assets. Let's say you provide $10,000 worth of stablecoins, say USDT or DAI, into a popular liquidity pool on a decentralized exchange like Uniswap. Every time someone trades between USDT and DAI on this exchange, they pay a small fee, typically around 0.3% of their trade amount. This fee is then distributed among everyone who has contributed to that liquidity pool based on their share of the total pool. A liquidity pool is simply where you put your money to provide the liquidity for these transactions to happen. And during a bull run, the number of transactions tends to skyrocket as investors enter and exit positions to capture gains. This means more volume in liquidity pools and therefore more transaction fees for liquidity providers. Unlike trading, where you're constantly chasing market trends, liquidity providing allows you to benefit from the increased activity without needing to make any trades yourself. Plus, unlike other crypto assets that can lose value in a flash, stablecoins maintain their value even during market downturns. This gives you a stable, predictable source of returns, making it an ideal anchor for a bull run strategy. You get exposure to DeFi returns without the roller coaster risks of other cryptos. Step number 2. Once you've built a stable foundation with low risk assets, it's time to add strength to your portfolio by providing liquidity for blue chip crypto assets like Bitcoin and Ethereum. Think of these as the reinforced steel beams in a high rise, reliable and resilient, especially during a bull run. Just as blue chip stocks provide stability and long-term growth, Bitcoin and Ethereum are widely trusted by both retail and institutional investors for their proven track records. Bitcoin, often called digital gold, acts as a store of value due to its limited supply and resistance to inflation. People see it as a safe haven, especially when economic conditions are uncertain. And then there's Ethereum, a bit different, but equally powerful. In a bull run, these blue chips often see the most consistent, sustainable growth. They're the go-to assets for large players who see long-term potential. So when Bitcoin and Ethereum start rising, the rest of the market often follows. Just imagine if you'd held Bitcoin back in 2016, where gains hit around 950% in just 1 year. With the anticipated bull run, these assets could deliver substantial returns while still providing a level of stability not found in smaller, more speculative coins. As I mentioned before, Bitcoin hit its all-time high just 24 hours after Trump's election, and it doesn't seem to be slowing down. Providing liquidity for Bitcoin could be a massively profitable move. Step number 3. With your stable foundation and blue chip assets in place, now comes the chance to add extra fuel to your portfolio by exploring high potential projects. Think of this as building an additional floor on top of the solid tower. These projects come with higher risks, but can also bring significant rewards, especially in a bullish market. In DeFi, high-yield projects and emerging platforms offer unique opportunities. The key in this is timing. When markets are booming, transaction volumes spike, which means more fees and higher returns for liquidity providers. However, because these projects are newer and more experimental, they require careful research. Look for platforms with strong teams, transparent roadmaps, and a solid track record. For an edge, join a trusted DeFi community where members share insights and monitor new developments, allowing you to spot high potential projects before they go mainstream. Approach these high-yield opportunities as the accelerant to your strategy, knowing that they can elevate returns but come with added risk. By balancing them with your stable foundation and blue chip core, you're setting yourself up to capture more of the bull run's upside while staying anchored in safer investments. Because the goal of bull run is not to tap into one meme coin, which is up one day and then crashes the next. If you're watching this, I'm sure you're a smart investor, meaning you'll want to secure stability in your portfolio while taking full advantage of this inevitable bull run. Well, good news, my friend. That 3-step system is how you can do that. However, there are still some things we need to solve. How do you know which platforms you can actually trust? Which opportunities are safest for your investment? How do you find the gems that deliver high yields without risking it all? How do you avoid the shiny projects that may look good but lack real substance? What criteria should you use to select these projects? How can you pinpoint the platforms where the big players are quietly positioning themselves? And most importantly, how can you get in early before everyone else? Because don't get me wrong, millions will be made in this upcoming bull run, but millions will also be lost. And if you don't want to be on the losing side, then I recommend you check out our free training that dives deep into exactly how you can get access to these high potential DeFi projects safely and strategically. This training gives you the exact blueprint for potentially securing your nest egg in this booming market, and it shows you the precise steps to locate and leverage these hidden opportunities. Thousands of everyday investors have used this approach to tap into market-beating returns while gaining greater control over their wealth. And now it's your chance to take control. So if you're serious about getting on board before the mainstream catches on and this mega bull run kicks off, click the link at the top of the description to access the free training. Take action now, and until next time, I'll see you on the other side. Cheers.